So my job today is to show you how we navigated the markets in 2024 and take you through some of the highlights in the portfolio that drove those returns. Now, it's been a fascinating year. It's had some really interesting challenges, but loads of exciting opportunities as well. One of those opportunities is British Airways. So we thought with that in mind, we would hop on a plane on the theme of planes, and I would take you around the world and we'd show you how and where we have been deploying your capital this year. So our first stop is the USA. Now, the Magnificent Seven have ridden on, but they have ridden into some very unwelcoming territory. They have pushed the S&P 500, the 500 largest companies in the US, to a valuation that is more expensive than 98% of history going back to 1881. There's only 2 times that they have been above this level. Once at the end of 2021, when the Magnificent Seven would fall 45% in 2022. Doesn't necessarily mean an immediate fall, but maybe more pernicious was the tech bubble of the early noughties, late 1990s, where the US would go on to return minus 1.4% per annum per year for the next 10 years. Now, US smaller companies are trading below a historic average, like the large part of the market was at the beginning of 2010 before they went on this run, but also a near historic discount to large caps like they were last time in the late 90s, early noughties. We know that that valuation is being driven by those large stocks, and if we can reduce that and build up responsible exposure, then we can limit the risk to those Magnificent Seven stocks. So it was music to our ears in February when the Chicago Mercantile Exchange released the S&P 500 equal weighted. Now that takes that record enormous 30% that the 7 stocks make up and reduces it equally weighted to 1.4%. It would be irresponsible to be out of the US, but it's a much more prudent way to build up your exposure. Since 1989, the S&P 500 equal weighted has outperformed the S&P market cap by 744 percentage points, even with the run that the S&P 500 market cap weighted has been on. So we've taken some of your S&P 500 exposure, put it in equal weighted, we've taken some more and we've put it into smaller companies. And they will outperform more in the long run despite the last couple of years. Buying the biggest, most expensive companies in the world is not a very good investment strategy. It will hamper your returns in the long run. Now, the other good bit of news is that the US, the S&P 500, may be at a premium to its long run average. There's only 2 other markets in the world that are, and that's Taiwan and India. Everything else is at a discount to long run averages, and we've been finding some of these opportunities. So I thought we'd hop back in the plane and we're going to fly over to Italy. Now, we screen thousands and thousands and thousands of stocks once every 2 weeks. In January, Unipol Gruppo, one of the largest insurers in Italy and one of the largest insurers in Europe, came up as scoring really highly based on their earnings, their dividends, their cash flow, their leverage, their margins. And if they score well, then they would be presented to the analysts to do a quality control check and make sure that what the model is suggesting is factual. So it went over to the analyst, and on February the 12th, we took a position. And within a couple of weeks, the market already begins to normalize to what we believe is a fair market value. And it was up 26% in 2 weeks, and it stormed on to being over 100% in the last week. It's going to take about 5 years to get paid back in the profit that it's making. The market is normally around 15 to 20 times earnings, and the US is currently above 30. Now, this was a bit of a no-brainer, but the model isn't always necessarily right immediately. I want to show you one where we have to overrule it initially, a Norwegian stock called MPCC Container Ships. Shipping is a very interesting space. It's not really done much for 10 years. In the run up to COVID, there's been a bit of noise. And then COVID came along. We all sat at home and started shopping. We bought phones, we bought TVs, consumer durables, and then suddenly there was no ships to ship all this stuff to us. Shipping prices went up 400%. Now, this pushed a lot of shipping companies to the top of our model. They're making so much money. So we take a look and we said, well, we're looking for sustainable businesses. We're not looking for flash in the pan businesses that just made a bit of money over 1 year. So we ignored them, and lo and behold, shipping prices normalized and a lot of them disappeared. But one company stayed at the top of the model, MPCC. And the reason they stayed at the top when we took a second glance at it was that they'd taken that windfall, they'd paid down all their debt, they revamped all of their ships, and then they said, we're going to pay out 75% of our earnings as a dividend. And at the price they were trading at, that dividend yield was 25%. 3 weeks before this seminar last year, we added it into the global portfolio. Since then, it's returned 60%. But when you take in that dividend, that ginormous dividend, it's up over 100%. It has already paid back in the 13 months that we've held it, the equivalent of 40% of our initial investment. And then shipping prices have stayed elevated, not as high as they were in COVID, but they've stayed elevated because of the Red Sea crisis, where the Houthis are attacking ships, and therefore the shipping containers have to go around the Cape of Good Hope, which limits supply because it takes longer to deliver it. So they've benefited from that. Now, it's really nice when these stocks normalize within a couple of months, or in the case of Unipol Grupo, a couple of weeks. But the truth is, it doesn't always happen like that. We build these big diversified portfolios, and sometimes we just have to wait. So to finish up on, I thought fly back to the UK and show you this in action in a stock that we spoke about last year, which was Barclays. Now, we actually bought Barclays back in June 2022. We were still speaking about it last year as an indicator of how cheap the UK had become, because Barclays' market value was at a 66% discount to its balance sheet assets. So we said this was pound coins on sale for 33p. Since then, it's normalized. It's been one of the top stocks in the UK portfolio and the multi-asset portfolios. But even at this level, it's still pound coins on sale for 66p. So we still think there's such attractive value out there, and this remains in the portfolio. Thank you. Merry Christmas, and have a wonderful New Year.